Welcome to Convince Me in 15 Minutes. This podcast will introduce you to concepts, theories, and philosophies in the world of finance, investing, and wealth management explained in 15 minutes. Your guides are Keith Thompson and Luke Tawas, who will act as both naive consumers and devil's advocate as they question the thesis that our guests will present. So join us for Convince Me in 15 Minutes, where you'll explore new ideas and challenge old assumptions.
My name is John-Luke Tyner. I'm a portfolio manager with Aptus Capital Advisors, and I'm here today to convince you in 15 minutes and 3 slides that over the next investing cycle, that it will be important for investors to incorporate volatility as an asset class in their portfolios, because we think stock and bond correlation will likely remain positive. Yeah, thanks guys for having me join. It's an honor to be part of your first podcast, and I hope this is productive for the listeners. So I think that as we start out this presentation, what I want to focus on is the implications to asset allocation portfolios and how several of these topics will be very influential to how portfolios can perform moving forward. So the first slide is going through basically the U.S. has a spending and a debt problem. And if you look on the left chart, basically that is the U.S. budget balance as a share of GDP. And as you can see, we're running pretty large deficits. It's negative. That means that we're spending more money than we're taking in from tax receipts. And so what that means as far as how that gets financed moving forward is there has to be more debt issued to actually pay for that. We're running a 9% deficit in relation to GDP currently, and that's levels that have run at warlike levels. That's a warlike level that we're running at now from a GDP perspective. But if you look at the last 3 years, the GDP growth that we've seen has been enormous. So the far right line of 40% looks at GDP growth since the COVID low. So obviously you're starting at a low point, but what you see is the economy has been running very hot since the post-COVID environment. And some of the implications of that have obviously been this fiscal deficit that we're talking about, where the U.S. is running at a perpetual deficit, but also a lot of it's been from inflation. And I think that there's several important factors that we must consider when we're constructing portfolios where inflation makes a big difference. And when you think about the options or the way out of a large debt problem, you've really got 3 techniques to get out that we've seen historically used. The first 2 are the most likely, and the third is what I'd consider somewhat of a pipe dream. So the first is just inflation. You inflate your way out of a debt problem. The second is deflation or austerity. Basically, you cut spending or you default on the debt, which isn't very likely for Uncle Sam or countries that have the reserve currency and a printing press to make up the deficits by deficit spending and printing. And then the third option is real growth, which comes from productivity and population. And productivity, maybe we can get some of that from this AI surge that we've seen, but from a population perspective, if you look across the globe, we're not growing. We're actually starting to shrink from a population perspective. And so, I think when you look at the implications that we've seen for asset allocation portfolios, the slide on the far right really hits the nail on the head. This looks at the annualized performance of 10-year U.S. government bonds, and I think it's safe to say it's been a bit of a rough patch for performance as interest rates have risen drastically as the Fed has hiked rates. And we're actually looking at the 3rd consecutive year of declines for 10-year government bonds, and that's never happened in our history. And so what you've seen in the slide on the left, which goes through essentially the S&P index and the Bloomberg Barclays Ag correlation. And so we've essentially looked at the past 20-year environment where investors have had ingrained in their head this philosophy that whenever stocks go down, bonds go up, and they hedge against risk asset portfolios. And what we've found is that's actually been far from the truth the last several years. And if you're building a portfolio and your stocks are your engine of your portfolio and your bonds you perceive as your brakes, and the brakes don't work, well, that puts you in a big problem. And we saw that loud and clear in 2022 with one of the worst year ever for a typical balanced 60-40 type of portfolio. And I think when you consider building portfolios looking ahead, and if you think that inflation is maybe more than likely the way out of this problem, well, bonds will very likely continue to be large laggards for portfolios, as well as have the inability to hedge against large market downturns. So really, the cusp of the problem is whenever inflation is volatile, that's when you see bond and stock portfolios not work as necessarily investors had planned. And I think the last point on this slide is if you look back to the mid 1970s and you look at stock and bond correlation, it obviously was a lot more choppy and positive than it was the last 20 years. And I think that looking at that uh, relationship moving forward, we expect more of what we saw from 1970 to 2000 than what we saw from 2000 to 2020. Yeah, and lastly, I think on this slide, it just gives a good idea of how markets are overall positioned. This chart looks at the VIX index, which is basically the fear gauge of the overall market. And while this doesn't necessarily relate to hedging on a specific level where there's different types of hedging, but what it gives us an idea of is how the market is pricing risk. And as you can see, we're back at levels that we haven't seen since pre-COVID. And what that means in my mind is essentially equity markets have bought into a soft landing narrative where the Fed is able to bring down inflation, the Fed is able to not destroy the job market where it's not doesn't destroy growth to the overall economy, and market participants continue to bid up stocks to pretty high valuations, and think that things will be fairly rosy. And ultimately, we've been ingrained, also similar to my last comment, that whenever markets get choppy, the Fed comes in and cuts rates and does actions that stop the bleed. Well, whenever we're in an inflationary type of regime like we are currently, that option might not be as readily available. And so when you think about using um, hedged products across the portfolio, given the amount of current headwinds that are in place, which we've listed to the right, and there's plenty, as well as the lack of bonds serving as hedge or breaks for portfolio, we think that hedge strategies present a really favorable risk reward profile for investors, whether it's investors that want to stay invested but are nervous, or whether it's investors that are really rethinking their overall portfolio asset allocation decisions. And so that's one of the focuses of this podcast in my mind, at least from our perspective and how we make decisions in building asset allocation portfolios, is we love the idea in a higher inflationary environment of owning more stocks, which we've seen the last couple of years. Stocks have had a pretty incredible ability to pass through costs to consumers, and that's helped stocks keep pace with inflation much better than what bonds have. And so, given that outlook, it makes sense to us as the price of hedging, whether it's using VIX options or using just the S&P 500 put options, it gives us a really nice opportunity to alter our portfolio allocations to really thrive for this new type of environment that we're facing.
Yeah, I was going to say, John Luke, I think I've got the advantage out of the three of us of being the old guy and remembering what it was like during the 70s and high inflation and people not investing even in CDs because their money market rate was so high. I do get this sense that consumers are now finally looking at fixed income as a legitimate alternative to the stock market. Does that play into any of this at all?
Yeah, I think certainly when you look at the front end of the yield curve, interest rates are extremely high. What we've been mildly surprised about has been investors' faith in extending duration and taking actually a haircut from a yield perspective, and in thinking that, hey, if we go into this recessionary environment, that the Fed's going to cut rates and we're going to see nice price return from bonds. So I do think that obviously fixed income on the front end of the curve is substantially more attractive than it was late 2020, where yields were basically at zero. But we are a little bit nervy of, given that the yield curve is inverted and given the deficit problems that are being faced, as well as, looking into the latter part of the year, there's about 2 trillion of additional treasury supply that's coming onto market. And in my mind, investors aren't being compensated enough given the resilience of the economy that we've seen to extend duration and have that hope that, as soon as the Fed cuts rates or we go into a recession, that yields are going to go back down to ZIRP like policy.
If you look at the slide on the left, it shows the projected average from 2023 to 2033, minus 6% per annum on average. And this doesn't, I mean, does this include the fact that I read somewhere that a third of the US debt is coming due in the next few years, which likely means at much higher interest rates than when those were financed years ago?
Yeah. Yeah, so the CBO, when making this budget, they have a guesstimate of where rates will be, but if you look at their guesstimate, it's substantially lower than the current level of rates. So they are, in fact, planning on, being able to refinance this debt at a lower rate. And of course, time will tell, and goes back to the higher for longer argument that the Fed is currently deploying with their interest rate policy. So
There's a saying that
it probably is pretty optimistic, honestly, even at these levels.
recognizing that we're heading into another election cycle, and that I think our politicians, regardless of what side they're on, will tend to pander to their audiences. I is it? I don't see it likely that austerity is an option up front. And there's an age-old saying that inflation is the one tax that you don't get to vote on.
Yeah.
Do we handicap these in terms of what's the likelihood, and does that inform kind of what you do in your own portfolios in terms of the way you hedge for things?
Yeah, spending cuts don't get reelected, so I have to remember that. Um, I do think that when we sculpt portfolios, really our mantra is more stocks, less bonds, and be long volatility. And if you think about an environment where we're running perpetual deficits, then someone's financing that, and the government obviously wants you to finance that at negative real yields. So after inflation, you're losing purchasing power. And I think what it ultimately points to is just the importance of building asset allocation portfolios properly for the times to come and not necessarily what's worked in modern history.
You made the point here with this slide that most people, I think, historically in their asset allocation, look at bonds as kind of their anchor to windward. And you've had a few years here where not only have they had challenging stock markets, specifically in 22, but you had the negative bond market to go along with it. I think our industry has been incredibly resourceful in terms of coming up with solutions that will work at some point in the market or at any point in the market. Is volatility a new asset class because of an environment like this?
Yeah, it's really a great question, and it's one I've been thinking about. As all of these companies have come out with different hedged or volatility-based products, does that take away even more of the demand for bonds? And I think that's a reasonable question. But ultimately, it comes down, in my mind, to the importance of building a diversified portfolio and having a plan with your asset allocation that you can stick to. Not all things are going to work at the same time, but it's pretty easy to make a compelling case against long-term bonds just given our inflation outlook moving forward, where if you're locking in your money into a potentially rising interest rate environment where, like I mentioned, the long end of the yield curve could still have problems moving forward just in terms of finding buyers. now that the central banks aren't, which the central banks are the largest buyers, at least the last 10 plus years of longer term debt. And if they're no longer involved, then that has to be priced at a market rate. And so I do think that how we've allowed volatility to serve as an asset class allows us to hold more of the things that we know can grow over both a medium and long term, which is stocks, and do so with a guardrail in place that allows us to mute or make the risk tolerance acceptable for different type of investors' preferences.
Well, John Luke, both Keith and I can't thank you enough for being on the show. And Keith, any parting thoughts?
No, John Luke, I can't tell you how much we appreciate this. This is these are some complicated concepts that I think a lot of consumers have never thought about in terms of deploying within their own portfolios. But I would imagine that this is a relatively new kind of concept, even for the typical financial professional who's trying to deploy this on behalf of their clients. So trying to educate them a little bit on some of these concepts and some of the potential outcomes that you can hope for in deploying some of these strategies, I think is incredibly important. So I want to thank you so much for taking the time for joining us today. We do appreciate it on our inaugural run of Convince Me in 3 slides in 15 minutes. So thanks again, John Luke. We appreciate it.
Yeah, thank you guys. It was a pleasure.